Hola, dear members and friends. As most of you know, my name is Clementina Guy. I'm the Executive Director of the U.S.-Mexico Chamber of Commerce Inter-American Chapter. Welcome and thank you for joining our webcast. The topic is the end of LIBOR, what to know and how to be ready. Even when this is expected to happen at the end of 2021, market participants continue to learn, adapt, and transition away from LIBOR. Before passing the microphone to our panelists, I want to thank Juan Carlos Pereira, Executive Director of the Spain U.S. Chamber of Commerce, and his whole team for all the support in the promotion of this event. Thank you, Juan Carlos. So now it's time to introduce our panelists. Oscar Stephens, shareholder of Greenberg Traurig. Oscar has deep experience in structures involving debtors and assets located in and revenues originated out of Central and South America in diverse transactions such as asset-backed securitizations, future flow structured finance, and other finance vehicles. Oscar will share this panel with Bernard Kaiser, Director and Head of Treasury Products and International at Itaú. Bernard is based in Santiago de Chile, and he has vast experience in the banking industry. Let me mention super quick, if you have questions, please send them through the chat, and at the end of the presentations, we will try to cover as many questions as we can. So welcome, Oscar and Bernard, please.
Thank you, Clementina, and thank you so much to the Chamber. It's a pleasure to be here sharing this panel with Bernard. And we wanted to cover this point because we feel that there isn't much of knowledge going around outside the circle composed by banks and lawyers. And I think for many companies, corporates, and even individuals, it's important to know what's going on and the big shift in the market that is happening right now, and it's going to continue all the way to next year and even beyond that. So thank you so much again. I'm going to upload the presentation right now. Give me 1 second. It sounds like we have the presentation uploaded. So first, we're going to give a little bit of background on how we got here, what is happening right now. We're going to discuss about current trends. What are the targets and the deadlines? What you need to know and when things are supposed to happen. What are the risks for a lot of people who are not really not very aware of what's happening, and this is probably for many of you the first time you're hearing about this. How does this going to affect me? That's going to be also a very important topic in this presentation. What's going to happen after LIBOR, after the end of LIBOR and the banks stop quoting LIBOR altogether, and what to do after that? What are the next steps, recommendations? What are the things that we can do to avoid more disruption in the market? So how do we get here? It was basically LIBOR is a rate universally for many banks, borrowers, and even individuals used for their financing transactions. And it's really an interest rate calculated by taking an average of quotations from banks in the London market. And that is really a reflection of something that is very subjective, which is every bank every day will give a quote to the UK authority and will provide what they think their cost of funding is going to be for the next period. And again, LIBOR is normally structured as a 1 month, 3 months, 6 months. So every bank gives a quotation, the authority compiles it, creates an average, and that is what is used in the market, and financial transaction is quoted publicly on a daily basis. So the question is, what happened? What happened was there was a lot of manipulation, and the banks really started to talk to each other in a way that it wasn't appropriate, and really, um, again, try to make sure that in some circumstances it will get a little higher, because of course higher interest rates that they were able to charge to their customers, it will mean more revenues for the bank. So it ended up in a big scandal. Many fines for a number of financial institutions, and eventually what happened is that in 2017, the FCA, which is the authority in charge of administering LIBOR, determined that because of this abuse, it was not going to persuade or compel banks to provide those quotes to calculate LIBOR. So it is, as of today, scheduled to end after 2021. And the banks themselves have not stated that they're going to continue submitting the LIBOR quotations after. So even though right now it's very evident that we're not going to have LIBOR after 2021, there's still a lot of noise in the market. There's still a number of developments and different rates that are being used and at least suggested for many different markets, which doesn't really give a lot of certainty and assurance to a number of market participants that this is going to be a very smooth transition. But first of all, let's go with Bernard, and your thoughts on whether discontinuing LIBOR altogether was the right decision, or it would have been preferable just to fix the things and the manipulation and all those and abuses that ended up with where the situation we are in today.
Thank you, Oscar. A very good question. It's a tricky question because from let's say from a bank perspective and from a client's perspective, I would say it's something that is quite disruptive. So disruptive in the sense that we need to really think differently in terms of having a new infrastructure, technological infrastructure. Not only the banks, but also the clients will be affected quite heavily by this. So from what you stated before, Oscar, we believe it is something that it's good for the markets. It gives more transparency. It is in line in order to avoid any misleading rates. But of course, the impact is very strong, very, very heavy on banks and on clients, especially on corporate clients. So just fix the issues instead, maybe not. It's something good to be having a completely new plan, but everybody needs to be ready for that. And that's a big challenge about this.
Indeed, is very challenging, and which is a very good segue to what is happening right now. So the first question is, who's going to be impacted by the transition? So this is an example of many different people who can use LIBOR on a regular basis. This is not just the banks. They're borrowers, they're consumers, people who have currently, for example, equity home loans, right? Mortgages that are subject to floating rates, student loans. So even people, for example, if you're looking at contracts, employment contracts where their own compensation may be subject to some form of interest rate that is going to be floating just to account for the cost of cost of money over time. M&A transactions, for example, where part of the price may be subject to an adjustment in the future. So there are a lot of different things and a lot of different contracts, a lot of different instruments that may or may not be sufficient, may not have even a replacement rate language that will address a complete termination of LIBOR. So very briefly, and Bernard mentioned this, I think, in his presentation, this is going to be very disruptive for the banks. It's going to change the way that they do business, their own valuation tools, how you're going to measure and how you're going to price. For example, every time that you're going to make a new loan to a new party, all those things are gonna people are gonna start from almost from zero with a white canvas, and it is not today a market that will provide a lot of answers to those questions. So in the beginning, and this is something that started in 2017, 2018, right after the FCA made a declaration in the United States, London, the European Union, Japan, Switzerland, all the major markets, they all started their own um, groups to try to determine which alternative reference rate is going to be the appropriate one for the replacement of LIBOR in the respective market. So here in the United States, the New York Fed created what is called the Alternative Reference Rates Committee, the ARC. I'm going to refer a lot to the ARC in this presentation. But again, the other group that is also very important is ISDA for all the derivatives market. So out of the approximately $1 trillion on in securities, instruments, loans, products, etc., a lot of that is derivative. So that would have been also, it's going to be very disruptive, although they have tackled that issue a little better than in some other markets. So the big point, however, is that the new rates, and again, this is a market convention, so there's no law that tells you that from rate X, you're going to have to switch to rate Y. This is what the parties agree in their own commercial transactions. But whatever new rate it is chosen by the parties is not going to be economically equivalent to LIBOR. And again, that creates a disruption and the change in the way that the banks are going to do business going forward. So going back to the point on how different markets have addressed this, we have, this is again, just a brief example. In United States, they have decided that the SOFR rate is going to be the one that will better reflect that change in the economic dynamic on the transfer of value between one rate to the other. In London, in the London market, Sonia, it's another is the rate that they have decided that will replace the sterling pound LIBOR rate for their transactions. And there's a number of differences that you can see on this little chart, but basically the main difference is that both Sonia and SOFR are what they call risk-free rates, right? So we discussed before in the how LIBOR is created, and the composition of LIBOR has what people call a term liquidity premium and a credit premium that really tries to reflect the cost of finance from each of the financial institutions. In the case of the new rates that are being proposed and will largely be used, it's called a risk-free rate, and especially in the United States, the situation is it does not have that credit liquidity premium. It doesn't have that subjective side of it, and is really based out of the U.S. Treasury bonds and the repo market for the U.S. Treasury bonds, which arguably is probably the safest instrument in the world right now. And we're going to explain a little bit of what SOFR means for that, but it is basically the cost of borrowing collateralized by U.S. Treasury securities. So again, takes the subjectivity from the determination of LIBOR and creates a rate that it's based on something that is objective. It's supposedly not very easy to manipulate, which is what they try to avoid after all the problems that LIBOR had, but it's very new. And that again, that creates a problem how people are going to continue to start, pricing things. And again, it's a market convention, so people still may decide to use different rates for the financial transactions. So in the end, there are a number of differences between SOFR, the way that we know it today, and LIBOR, the way that we're used to. But the main difference for, and this is going to be also very important for financial institutions and borrowers as well, because LIBOR is quoted on a daily basis, but it's quoted going forward, looking at a 1 month, 3 month, 6 month, 180 days. So from on a financial transaction, you will know at the beginning of your interest period what's going to be your debt service on your payment date for that transaction. And in case of SOFR, there is currently, and again highlighting the word currently, there's no term structure. So SOFR being overnight rate, SOFR is quoted on a daily basis. And today, the only type of SOFR, maybe I should rephrase that, but the most popular type of SOFR that is being used today in the market, it's a rate that is only calculated at the end of the interest rate period. So that creates, again, the disruption that Bernard was mentioning earlier and the way that the banks do business. So here, this is a very simple way to show the determination date on a LIBOR transaction is really known at the beginning of the interest period. It's paid on the payment date. And in case of SOFR, as you see, every day there's one SOFR rate that is getting quoted, and you can find it on Bloomberg or the Fed website. But in the end, you're only going to know your actual debt service at the end of the period once you're able to calculate it. And the problem is also right now, there are many different ways to calculate SOFR. We're going to talk about that in a moment. But here for Bernard and his views on how much this is going to change the way you do business and whether you believe that SOFR is an adequate replacement.
Yes, right. This is change very much the way we do business. Already, although it's been stated before by somebody else, but I would like to repeat it. For the banks, at least, the change from LIBOR to SOFR or to a risk-free rate scenario, which we're not completely sure about the final rate. This whole thing is like it has a stronger impact than maybe the Brexit on the banking system. So it's really, as I said, disruptive. So it will change the way we do business, because first, we as a bank and all of the banks must learn how to understand SOFR, how to manage our balance sheets, assets and liabilities with the new rates. And we need to address our clients, and we need to first make everybody in our bank understand how this works, which is not the case in most of the banks. Maybe the project team knows about it, but it's really important to have everybody participating in this, especially those relationship managers that need to bring this message to their clients, explain what is going on, and how this will impact the clients. And then how are we going to fix the new pricing, the new rates? And we're not speaking about the moment when the end of the LIBOR kicks in, which is in January 2022, but before that, because the banks already need to prepare themselves in order to start new loans in new risk-free rates, let's say SOFR, for example. So we really need to talk to our clients. Our clients need to understand it. We need to change documentation. We need to have fallback clauses. We need to define new clauses for the new rates, and what most impacts and most interests clients as well. What is the new pricing that they were giving to me? Because before, LIBOR was a rate that already included some credit risk, the credit risk of the bank itself. So the new risk-free rates will have a totally different approach. We will need to understand ourselves as a bank and make our clients understand which is the spread that we need to add on the new rates, on the new risk-free rates, in order to reflect the same spread that the bank was earning before on the LIBOR basis. So it will change a lot. SOFR as an adequate replacement, well, this is a question that is being discussed already for quite a while. The different committees worldwide, the banking system worldwide. So SOFR is probably from those alternative rates that are on the table in order to have a choice. Probably it's the most adequate, but it's probably not the most adequate for everyone. Okay, so far might be adequate for the large banks, but for medium-sized banks, for smaller banks, it might not be the perfect rate. So this is something that's on the table as well to be discussed among the regulators and the banking system. So is it the best solution for everyone? Probably not, but it's a general benchmark for the larger banks.
That is a great point, because you could even argue that LIBOR was being used for many different transactions, but probably was not really the best way to address certain issues in credit, for example, M&A transactions or employment contracts. And we have LIBOR now that is embedded in the whole world, and not just banks and financial transactions, but many other things. So how, if you think you're getting impacted, what is the point that we're trying to make here? I think that the main message, and I suppose there's two messages, is that COVID did not, as expected, delay the plans for LIBOR transition by the end of 2021. There was an assumption in the market that this was going to happen, that people were going to really delay the plans and give a little more time for people to adjust, but that's not going to be the case, and nothing indicates today that they're going to give an extension with respect to the previous declaration back in 2017 that it's not going to compel the banks to do the rates. And the second point is, yes, people are expecting by the end of 2021, LIBOR will not be used anymore, but the real date of the transition is probably going to be somewhere around June 30, because you still need some transition period whereby the banks need to adjust their systems, adjust their pricing, adjust the way that they do business, as Bernard was saying. So here is another very good chart related to what has been the best practices recommended by the ARC. And you can see that there are a few dates in 2020 and 2021 that become very, very relevant. So, for example, it's very important to, again, address the best practices, and the recommendation is for banks to stop making loans by June 30, 2021. So if you're on the side of the bank, you need to be ready. You need to have your systems ready by then. And if you're a borrower, you're also going to need to understand SOFR and what are the implications today. And this is a very good way to show the way that how these two rates compare to one another. Again, the green line that you see here is overnight SOFR. So this is the rate that is being quoted every day, compared to the 3-month LIBOR, which is the white line. And overall, you can see that the lines and the curves have been somewhat similar. But there are a couple of points here. And the first one is, you see on the left side of September last year, there was a big peak on the SOFR rate overnight, which was something very strange. People got very nervous about it. They still can't explain how that happened, and give ammunition to those who still think that SOFR is not the right rate. And the second part is when you see the dip in the SOFR curve around March this year, when coronavirus really started hitting, and you can see the difference between that curve and the LIBOR curve, and that can be explained because SOFR is based on the Treasury rates. Once the Treasury bonds and the Fed in the Federal Reserve in the United States, they decrease the interest rates, obviously their price of their paper is going to go down. On the other hand, when there's uncertain economic conditions, the banks are going to start quoting that their own cost of funding is going to increase. That cost has to be passed to customers, and therefore it's going to increase the LIBOR rate. So after a first couple of months, which was probably consistent with the passing of the stimulus package in the United States, things started to go a little bit around the same level. But in terms of pricing, if you see, and this is again a very rough calculation on how the 3-month SOFR, again calculated the way that we know it today, that you just look back and do an average of the SOFR rates over a period of time compared to 3-month LIBOR, that they somewhat look alike. So people, I think, initially got a lot of comfort based on this, and again, whether or not it's gonna remain like this, no one really knows. And I think goes back to the point that Bernard was saying earlier, that this may work for a lot of people, but not for everybody. So Bernard, and we've talked a lot about the economics of this. So do you think, or have you seen in the market that the banks in general are ready and they have the systems in place to move from one rate to another in a smooth fashion?
Yeah, I would differentiate, let's say, split in two. First, the systems themselves, I would say in general, probably not, because this will affect the core system and many systems from the bank. So there needs a lot to be done in terms of reviewing if the systems are capable of doing this, if the banks are going to have develop new systems or change their systems internally, or opt for external solutions. Let's say for external provider who will be able to have a plug and play solution, which is of course more costly, but at the end it enables banks to focus on things which are not developing new systems, IT systems. So, but of course, the banks need to be prepared in terms of content. So we need to have all the approvals, internal approvals regarding the new curves. We need to be capable of accessing the market, to have our accounting adapted to everything. So this is something that most banks are still working on. Even the largest banks worldwide, they're still working on. They have large project teams working on this throughout the bank. It's from accounting, it's from the relationship management, it's from treasury, from operations, IT. So there's a lot to be done there. And what is most, I would say, the most difficult thing is for medium-sized and smaller banks, which are now realizing that this is something that takes a lot of more time and probably more resources in order to invest into systems. And the time is running because, as I said before, it's not starting January 22, but we need to be ready before that in order to be ready to offer this before. So it's not a big bang in January 2022, but it needs to be implemented before. So short answer, no, most systems are not yet ready to take on this transition, but all the banks are working on it.
That's good news. And I think that here is a big point, right? Because we have to differentiate those loans that are being produced today where people are aware of the situation and that have an alternative rate language that is based on the templates or is not based on templates, but at least takes charge of the considerations related to what's going to happen with LIBOR after it is discontinued permanently, right? So there are a number of contracts that likely were signed in 2018, before that, that never addressed or never even thought that LIBOR was going to be terminated at some point. And here's the real risk that you may have today a contract or a series of contracts where that defines LIBOR, but it doesn't say anything about what happens with LIBOR or the rate if it's not published at all. Many contracts today refer to only temporary disruptions of LIBOR. We would effectively make a floating rate contract or a floating rate financial transaction into a fixed rate transaction, which again, not something that the banks like to see in their transactions, because they like to be able to protect themselves to the fluctuations of the market and what people call credit risk. But there are also a number of contracts that could refer back to a rate that is prime, and prime today is, I think, about 300 basis points above LIBOR. So you could find yourself in a situation where your contract may be completely valid, but eventually says, if LIBOR doesn't exist, I'm gonna price at prime, and overnight, if you're a borrower, your loan is gonna increase a lot, and that may have other implications, not just cost, but also financial covenants and things like that. So in the end, what many of these industry groups like ISDA and the ARC have been trying to address is the fact of the value transfer, that the moment that if you have a contract that it does or doesn't have the good fallback language, what's going to be the change that is going to be fair for both parties, so you don't end up with a winning party and a losing party. If you have a contract where your rate or your cost of funding or borrowing is going to decrease, you're going to have very little incentive to do that. So what's going to be that situation? Again, it could result in a number of different scenarios, and thank God, or God forbid, litigation. So one of the things that people are adopting right now are what people call the ARC templates, or the fallback language. And today, I will say that since these were first published in the market back in 2019, in some cases, a little earlier in others, they've been fairly adopted in the market, and a lot of people today are very knowledgeable of what is called the amendment approach and the hardwire approach. And very roughly, today, if you're entering into a loan today, you're likely to find one of these two approaches in a financial transaction. And the amendment approach is basically, very roughly, an agreement that in the future, the parties will select a rate that is going to be consistent with market practices. And depending on your ability to negotiate it, you may or may not have consent rights, but in basically, it's sort of like an agreement to look at this issue down the road and say yes or no, with an adjustment to the margin that Bernard was referring earlier. So, for example, today you have a loan that is LIBOR, 3-month LIBOR plus 3. That margin or spread is going to be subject to a formula that is going to try to reflect the economic value of what you had before. If LIBOR plus 3 is going to be SOFR plus 3 plus something, for example, or minus something, depending on how the average is going to behave at that point, which again takes a lot on the part of the banks to educate their customers and tell them, hey, by the way, your loan is going to increase or going to decrease, and here's why. And the other approach is the hardwired approach, which has been recommended by the ARC and on the industry groups, where it will tell you the moment that people stop using LIBOR, we're going to go through a waterfall of options. If there's one option that is not available, we're going to go to the next and so on. And today we have in the hardwired approach, the first stop is term SOFR, which doesn't exist today. And then the second one is daily SOFR, which again is a backward looking rate that people will calculate at the end of the interest period. So that's where we are today on all the template languages. And as I was saying, if your contract, financial transaction, your loan, your promissory note doesn't have a good, adequate fallback provision, you may end up in one of these situations where you end up with litigation. Under many different theories of frustration or breach of contract, if you can't perform your contract because you can't really determine what is going to be the rate, you may end up in that situation. And there's also the other side, the flip side of that is reputational risk. If you're in the winning side, I was saying earlier, you may not have a lot of incentive to amend your contract. And if you're a bank, if you're the strong party, that's not gonna be it's not gonna look very good on your reputation, and again could eventually give rise to class actions and things like that. So simple rule of thumb, if there's a loan that you're entering today with the bank, and it's still on LIBOR, it is recommended to use a template language. And if you don't have one, and if you don't have that language in your contracts, you have to diligence the loan and really go see what they say. Because this is the problem. And again, it goes back to the point that this is not really a December 2021 problem where, arguably we could have the replacement date. This is something that is going to start before that, halfway through next year, where people are going to start looking and amending a number of contracts. This can create a real dangerous bottleneck, because if you imagine a bank that has to amend all their contracts very quickly with a lot of people, there's just not going to be the sufficient manpower to do this in a very short period of time. And a good way to look at this is really, what is your exposure? And this is a very good way to at least put it in a picture. But it starts with looking at what is your universe of contracts, see what the different provisions say, prioritize them, and then start looking and engaging directly with the counterparties and hopefully amend a contract. And again, imagine if we have to do all of this in a very short period of time, it's going to be time consuming and it's going to be very costly for a lot of people. So Bernard, in your view, what message are the banks currently giving to their clients and counterparties? Have we started that process of communicating this issue with your other sides?
Yes, this is something that I would say the larger banks have already done. They've started communicating with their clients. And of course, this is something that when we as a bank thought it was new to us, and we're now quite used to this topic, we realized that for the clients, it's something that probably many of the clients have never heard about it or are quite surprised. So this is something also that doesn't appear, let's say, maybe yes, in the US or on the large financial centers, it's part of the specialized press. But for most banks, regional banks or international banks, this is something that has not been addressed by regulators. Maybe it's just starting to being addressed. It's not in the press, as I said. Clients won't read it. corporates won't read it except if they really are into treasury, into the financial topics. So this is something quite a big surprise. So this is a difficult task, because since nobody has a real, let's say, the new rate, it's not that there is already defined a new rate. You were speaking about SOFR, which is one of the alternatives. Most probably it's going to be the used alternative by many banks, but not by all banks. So what can the bank explain to the to the customer? It's dynamic, it's still moving, it's not defined, everything defined yet. So yes, banks are moving on, they're contacting their clients in order to make them understand what's going on. And of course, because they also need to review the legal documentation, and especially banks need to be prepared and clients need to be prepared that at some point in time, early next year, the new loans that are dispersed, they might be not in LIBOR, but in SOFR, or an alternative rate. So this is one of the main exercises that's being done right now. And we also realize that clients have a very difficult time in adopting this. So the most important thing is here creating transparency about the information, about the new rates, how it works, and that it's all, for all of us, is something new that we need to reconsider and that we need to build on. So it's something that also needs to be discussed with the regulators. So there's a lot to be done in terms of bringing the message not only to the clients but also to the regulators, but because this is creates an impact to all of us in the banking system.
And that's what we're doing this webinar, right?
Right.
So very, very quickly, the reality is that after LIBOR goes away, we're going to end up with a number of different variants of SOFR. And the two on the left, you will see that they're the in arrears variations of SOFR that, again, they're calculated at the end of the interest period. And is, again, is a different way that the banks do business compared to the ones on the right column, where it compounded in advance and forward-looking term SOFR. And the last one really doesn't exist today, but people hope that by the end of or by mid next year, there will be a decent way to calculate term SOFR, which will be based upon futures. And again, that market is still under development. And the more that the market it gets created, the least chance for manipulation there will be, or that's the expectation at least. And again, software is not really perfect. And a couple of things that we have mentioned here, that is really not credit sensitive, that is subject to the volatility of the repo markets. And we saw that big jump. But again, as I think Bernard said it correctly very, very recently, it's probably not going to work for everybody. In the United States, a lot of the regional banks that prefer a Maribor, which works more like LIBOR, it reflects their cost of funding better. So again, we're not only we're not going to be in a world where we may have not only a number of different SOFR rates, but we may be dealing with a different number of rates, period. And here are a couple of just a few examples on issues on SOFR. Whether the systems are going to be there, what's going to be the situation in the secondary market, how are you going to determine the applicable margin or the spread. And here, I think there just has to be a period where banks are going to start quoting different rates, and things are going to have to percolate, because again, today there's no active SOFR market that people can rely upon. And you may end up in a situation where you go to a bank and they ask them for a SOFR rate and may not be able to give you one because they don't know how to price it. So there's still a number of things. And again, this all being very disruptive. We're very short on time right now. This is not a 1 year thing or a little more than that. This is really a 6 month thing where people are going to have to adapt very quickly. And a few other points, I'm not going to get into too much detail, but there are a number of things in existing documentation under New York law, at least, that are very common, and we don't know yet if they're going to continue working in the future. So, for example, legality, yield protection, break funding. You could argue that you don't need those anymore if there's no credit component on the rate. That, for example, things that they were the clauses that they were mainly created right after the financial crisis in 2008 and 2008, is that going to be applicable for something that, again, is risk-free? No one can really answer those questions right now. But there are a few good news. For example, the IRS has given some indication that the switch from one rate to the other is not going to be a taxable event. On the accounting side, there's guidance that the modification from the number of loans from one rate to the other is not going to incur in remeasurement. There is consistency with the derivatives market. And again, on the spread adjustment calculations, there's a little better sense on what's going to be the formula is going to be announced, and something that's going to be publicly available in Bloomberg. But again, we're not out of the woods yet. COVID-19 has delayed a lot of the LIBOR transition efforts. And I think this is not something that is top of mind, as Bernard was saying. This is sort of a very important thing. It's a Y2K scenario for the financial industry, but no one really knows about it. And things are moving very slowly still. So, Bernard, given that this is 2020, do you think COVID has affected in general, not only your transition plans, but just the market transition plans? Since, again, that's what seems to be in the top of mind of from everybody right now.
Yes, I would say definitely, because everything that was already, let's say, on a stress scenario, because we had this new project, the IBOR transition. Now we need to, I would say we probably have lost a couple of, not weeks, months, in order to be able to concentrate on this, because we had our other urgencies, other problems somewhere else. So we, of course, as a bank, ask other banks if the banking association can approach the regulators and say, look, actually, we really need to focus on other things and not on the LIBOR transition. But the thing is that the response that we have got as a banking industry is unfortunately not. This is going to go on as scheduled. So we really need to speed up, because everything and the whole deployment of the bank has been affected by the COVID-19. Absolutely.
So there are a couple of points, and I think we're going to be over in a few minutes. So it is basically very relevant that there was a recent declaration that there could be a pre-cessation event happening by the end of this year or early next year. Things are still very fluid right now. The protocols for derivatives were just published, and the view is that probably it's going to be a few months until this declaration is made. But this could really put everything into motion, right? If people finally, if there's a declaration that is made that is going to trigger one of the fallback provisions in existing loan agreements, are going to move everything from LIBOR to SOFR or another rate, this could even accelerate further the timeline that we have discussed today by during 2021. And again, this could also be very disruptive in itself. Imagine that overnight someone tells you that things are changing and you need to be ready in 3 months. That's going to create issues on pricing and what is called the cliff effect on the spread calculation. So if people are doing LIBOR loans today and they're pricing at a certain level, well, if you can make LIBOR loans tomorrow, how is that going to affect the pricing and your structure on your transaction? So A few unknowns, as we said before. There's still no forward-looking term SOFR rate. There is no SOFR market today that is widely understood. There is some in the bond market, mainly thanks to Fannie and Freddie, but there's still traction, but it's been very slow this year, slower than people thought. What's going to be the effect of zombie LIBOR? What happens, for example, if there's still LIBOR by some point next year, and banks keep quoting it past 2021, or after there's been a declaration that is what is quote unquote no longer representative? Is it really reflect your cost of financing, what the parties had in mind when they entered into the transaction? There is a proposal of a New York State legislation that would potentially cure a lot of these contracts that are defective. We don't know yet, and there was an election yesterday, so people have their minds in other places right now. And other things are very practical. For example, who pays, right? So if a bank approaches you and tells you you have to amend your loan, well, I'm going to have to pay lawyers, but well, are you going to pay my lawyers, or I'm going to pay my own lawyers? So that's also very, again, things that people are just looking at it and deciding on the spot. So how much do you think this stuff affects the transition plans, Bernard?
It's the road is filled with obstacles, so it will be quite bumpy. Absolutely. What other unknown could affect us? I mean, in terms of systems, I think this is one of our main, from a bank's perspective, one of our main concerns is if there is not enough time in order to address change in the systems. So what should we do? This is one, let's say it's not an unknown, but it's one of the main issues, and probably the banks are afraid that there could be this additional unknown coming from the IT side, that the banks are not capable of implementing the systems that are needed to adopt the changes.
Okay. So finally, our recommendations, build a team, work in your systems, create a program. If this is the first time you're hearing about this, go talk to your CFO. If this is something that you heard about before but didn't know how bad it was, it is very bad. And you should talk to your lawyers and advisors and accountants. So stay current, educate your team. This is very important. This is from an article that we saw recently, but the banks have already identified that they're short of people right now. And it's estimated that about 250,000 people are going to be necessary, that today they're not employed by many financial institutions. They're going to be needed for amending all these contracts that are defective. So again, goes back to the point on amending a lot of things, deciding a lot of things in a very short period of time. It could be a recipe for disaster. So I'm going to leave it here because Clementina, I think we may have some questions. Bernard has to leave right now, but I'll be happy to stay here and answer the questions that you may have. And if there aren't any questions, I can go briefly through the list that I have right here.
Have you find the questions, Oscar, or do you want me to read the questions for you?
Yeah, if you want to read the questions, go ahead, but maybe we can say goodbye to Bernard, who has to leave right now.
Yeah, thank you, Bernard. Thank you very much. We recorded this webinar, so and I'm also going to share with the attendees your information. So if someone has any kind of questions, you can contact our panelists. But thank you, Bernard. Thank you very much.
Okay, thank you very much.
Thank you.
Thank you. Bye-bye. Take care.
Thank you, Bernard.
Bye.
So I see there's a question here. I just opened the chat. It says, do you think most people in the business find more problematic to go from almost universal LIBOR to a more regional and differently calculated SOFR? Sonia, Saron, Onia, Esther. Especially, can you share your thoughts on short-term versus long-term, and what you also pointed out, larger versus smaller financial institutions? Would this be sustainable over time? Or do you foresee it would end up converging into a universal rate that can be used similar to LIBOR with more strict parameters and its calculation? That's a very good question, and there's a lot to unpack here, because I think we're very, I want to use the word spoiled, right? That we had a USD LIBOR that it was used for a lot of different things, not just loan agreements and financial transactions. And that seemed, again, to be working just fine. And now we're going into this period of high stress scenario where what's going to happen with the different types of SOFR. And I want to focus on SOFR a little bit more because I don't have a lot of knowledge on what's happening from a commercial point of view on the other markets. But again, there are a number of smaller banks, as I mentioned earlier, they're using Ameribor. I've spoken to a number of accredited investors, insurance companies that are big players in the private placement market that have said already that they don't want SOFR and they want to use prime. So they're basically charging prime with a smaller margin. And that seems to be working just fine for them from the outset of the transactions. Whether or not it's going to be sustainable over time, I mean, the answer is maybe. I think we can all adapt. Again, I think it goes back to the point of whether something, a one-size-fits-all situation. I think the biggest issue, if you ask me, that I think is partly solved was the mismatch between the cash markets and the derivatives market. That seems to be working almost consistently now that the protocols are out. I would expect that people are probably going to be a little on the new contracts, on the new fallback languages, something a little closer to what the ISDA documents say. And I think it's just going to take a little time to, finally weed out the things that are not working. And again, this is a market convention. This is not a legal issue per se. We as lawyers take a look at what are the risks in existing transactions, but in the end, the parties may decide what to do. And I think for the most part, I would expect that the market are going to start following the big players. So for the big banks, if they're going to adopt SOFR in a way that it makes sense, that is sort of neutral in the cost effect to a number of people, I would expect that a lot of the different banks are going to start following the same approach. So I think they're going to try to take a safety in numbers approach in a number of these situations. And then over time, people may decide whether something is working for them or not working for them. So it's very disruptive to almost change a whole financial system overnight and expect to work. And now that we have even less time, it can be very chaotic. And whether or not it has going to be strict parameters in the calculation, I think that's one of the main points is whether or not from the outset that a new rate should have a credit risk component where if my cost of funding as a bank is going to become more expensive, whether or not I can pass that cost to my customer, right? That's how the curves normally go and fluctuate between the one bank to the other compared to SOFR, which is expected to be a little more static. Whether that's going to work over time, no one knows really. But that's why people have hedges and other instruments to account for that. I think that's the answer. Clementina.
Yeah, we have a couple of questions more. Jose Luis is asking, have you thought how the interest rate hedge is going to work?
How's it gonna work? Well, it's first of all, the existing derivatives contracts, the ISDA forms, they have already published, and I think this happened a couple of weeks ago, what they call the protocols, where they're gonna incorporate many definitions addressing the termination of LIBOR that are currently in the existing ISDA contracts. And I think among banks and the transactions bank to bank, they will be widely adopted. So from the derivatives market, I think a lot of it's a little bit of a different product. So I think people were expecting to adopt those protocols and go from there. What's going to be also a little interesting is for the over-the-counter derivatives, the expectation is that the parties will have to really sign them and adopt it. So it's also going to take a little time for people to understand what they say, to get comfortable with it. But I would expect also that it's going to be a little more, again, driven by the banks. And the banks is just going to say, well, sign here. And if you don't, it's just bad news for you because it may be a termination event of your derivative. And in that situation, you're just gonna go talk to your lawyer, and your lawyer, probably a derivatives lawyer, is gonna say, "Yep, this is what you have to sign. There's really no way to change this, and just sign here and move on." So I think in for what was the biggest risk, which was the derivatives market, that risk has been mitigated a lot by the protocols. Now, they came a little later than expected. There's still the coordination with the cash markets. So there's still a lot of work to do, but the biggest hurdle is what that this protocol is going to say. Well, now we know, and people are expected to adopt them.
Last question, because we are over time. Aileen is asking, what would you estimate will be an appropriate spread differential to be added to a margin spread to compensate for the difference between the risk-free rate of SOFR and LIBOR, which is a risk rate considering SOFR is backward looking and LIBOR is forward looking?
Sorry about that. Well, the good news is that we have an answer to that. It's not what I think, which probably, I think barely my kids listen to what I say at my home. But the point here is that there's already a good sense on how the different spread adjustments are going to work. And the good news is that there's going to be consistency between the cash markets and their derivatives market, and they're all going to apply a formula using a 5-year look back period. So they're going to take the two curves, the LIBOR curve and the SOFR curve for the different products. So for example, you're gonna look the 3-month LIBOR versus 3-month daily SOFR, right? And then you're gonna get a number, and you're gonna apply that number to your applicable margin and use that. So that is going to be something that I think it's already been published in Bloomberg. People will be able to look at it. The contracts currently, that the templates currently provide that people have to use the adjustment mechanics that has been recommended by the New York Fed, and that's probably going to be the one. So there is a way to determine. Now, it's all everything tries to be as agnostic as possible, so it doesn't create this winners or losers situation. Now, the question is whether the banks are going to be the losers, and well, that's another topic, right? Banks don't like to lose, and if all the banks lose, it's going to create also a lot of disruption for that. But if you're the borrower, and your bank tells you overnight, by the way, your loan is going to be from 3-month LIBOR plus 3 to 3 months SOFR plus 3 plus something else, how happy are you going to be? Probably not going to be very happy. Now, the reality is that many banks, if not all the banks, are probably going to use exactly the same methodology, mechanism, interest rate for everything. So there's going to be safety in numbers. If a bank starts operating different than other banks or treating customers within the bank differently, that could be a potential risk and even litigation. So I think probably banks are going to try to avoid that.
Well, I think that that's it. Thank you, Oscar, for this interesting presentation. I really appreciate the time that you invested in our project and our members. As I mentioned before, we recorded the webinar, so it will be available in our social media channels. And please do not hesitate to contact me if you need help for you or for your business. And thank you. Take care and stay safe. Thank you, Oscar.
Thank you.